Choosing the right business structure can make or break your entrepreneurial journey. If you're considering forming an LLC, one of the first decisions you'll face is whether to establish a single-member or multi-member LLC. This choice affects everything from your tax obligations to your personal liability protection. Limited liability companies, or LLCs, have become one of the most popular business structures in the United States because they offer liability protection without the complexity of corporations. The fundamental difference between single-member and multi-member LLCs is exactly what it sounds like. One has a single owner, while the other has two or more owners. A single-member LLC is a limited liability company with just one owner. This structure provides you with more liability protection than a sole proprietorship while maintaining simplicity. The IRS considers single-member LLCs as disregarded entities, typically taxing them like sole proprietorships. On the other hand, a multi-member LLC has two or more owners, called members. These businesses combine the liability protection of corporations with the tax benefits and flexibility of partnerships. By default, the IRS taxes multi-member LLCs as partnerships. When comparing these two structures, ownership and control represent the most obvious difference. In a single-member LLC, the sole owner makes all business decisions independently. They have complete control over operations, strategy, and finances. Multi-member LLCs distribute decision-making power among multiple owners based on their ownership percentages or according to terms specified in the operating agreement. Taxation also differs significantly between these structures. Single-member LLCs report business income and expenses on Schedule C of the owner's personal tax return. Multi-member LLCs must file Form 1065, a partnership tax return, and distribute Schedule K-1 forms to each member showing their share of profits and losses. Regarding liability protection, both structures shield personal assets from business debts and lawsuits. However, courts have historically been more likely to uphold the liability shield in multi-member LLCs, especially when proper formalities are maintained. Single-member LLCs may face greater scrutiny in court, making operating agreements and separation of personal and business finances particularly important. Single-member LLCs offer several distinct advantages. They provide simplicity in management and decision-making. The business name receives protection through state registration. Tax preparation remains straightforward, with income reported on a Schedule C. There are typically no minimum tax fees, unlike some traditional LLCs in certain states. And the regulatory requirements are minimal compared to corporations. No directors, officers, annual board meetings, or stockholder elections. However, single-member LLCs do have disadvantages. They require more paperwork than sole proprietorships, including annual reports in most states. State laws often provide stronger protection to multi-member LLCs, with 18 states currently preventing plaintiffs from accessing LLC property to settle personal obligations. Single-member LLCs may also face challenges when seeking credit, raising capital, or establishing business value compared to corporations. So, when should you choose each type? A single-member LLC makes sense if you're launching a solo venture, want complete decision-making control, prefer a simple tax structure, or plan to potentially convert to a multi-member LLC later as your business grows. Consider a multi-member LLC if you're starting a business with partners, need to raise capital from investors, want to share business responsibilities and risk, or desire the potentially stronger liability protection that comes with multiple members. The good news is that LLCs offer flexibility if your needs change. Converting from a single member to a multi-member LLC involves adding new members, updating your operating agreement, notifying your state's business registration agency if required, and potentially applying for a new EIN from the IRS if the ownership structure changes significantly. Converting from multi-member to single-member requires buying out or removing members according to your operating agreement, updating state records, and amending your tax status with the IRS. Regardless of which structure you choose, an operating agreement is crucial. For single-member LLCs, this document reinforces separation from the owner for liability protection, clarifies succession plans, and demonstrates legitimacy to banks and investors. For multi-member LLCs, it defines member roles, voting rights, profit distribution, and procedures for adding or removing members. Both single-member and multi-member LLCs offer valuable benefits for business owners. Single-member LLCs provide simplicity, full control, and straightforward taxation. Multi-member LLCs enable shared ownership, collaboration, and potentially stronger asset protection. Both structures offer limited liability protection, though their legal and tax obligations differ significantly. The right choice depends on your specific business goals, number of owners, and growth plans. Whichever structure you select, creating a comprehensive operating agreement and maintaining proper business formalities will help ensure your LLC provides the protection and benefits you need.